The year has started with a significant amount of global economic and financial turmoil. And of course, in addition to economic and the financial risk, there are also geopolitical risk. What's happening right now in the Middle East that is burning and potential for contagion in financial market and economy, the risk of terrorism, the Russia-Ukraine conflict and the fact that the Russian bear is becoming more aggressive, the political problems of Europe and the Eurozone, where you could have disintegration and balkanization, and of course the implication of the rise of China, and is it going to be peaceful or not? Lots of geopolitical questions. And therefore people now are asking the questions are we going to have another global financial crisis? Are we going to have another global recession? Are we going to start to have a correction in equity market, or are we going to be at the start of a rout, of a new bear market? Why is oil prices falling, and is it a good sign or bad sign for the global economy? If the price of oil is falling because there is too much supply, on net that's bad for producers and net exporters, but it's good for the global economy because you're redistributing income from those who are saving it, all exporters, to those who are spending, that are all consumers. However, lately I think that the reasons why oil prices are falling is not just the glut of supply, but also lack of global aggregate demand. China is slowing down, emerging markets are slowing down, even the US is slowing down. And if the fall in oil price is a signal of weak global growth, then it's a negative. And that's why stock markets, the US and globally, have reacted negatively to the recent fall in oil prices. It's a signal of weakness in global economic growth. What's going to happen to the global economy this year? For now, has been a mild economic expansion since October. Positive growth that was beginning to accelerate. But like last year, shocks like China and others can lead to a deceleration of growth, and this expansion becoming a slowdown. And I think that's the most likely scenario. So we're going to go from an expansion to a slowdown, and the question is, are we going to go to an outright contraction, a recession? I would rule out a recession scenario because that would require a collapse of China, a collapse of emerging markets, a stall of growth in US, Europe, and Japan. It's a tail risk, but a 20% probability. But this expansion that was already lukewarm and anemic might become an economic slowdown. And if it becomes an economic slowdown, the correction in global equity market could become a bear market. And if it becomes a bear market, it's going to feed back to the real economy, leading to another loop downwards in economic slowdown. So that's a risk for this year. So the good news is we may not have another global recession. The good news is we're not going to have another global financial crisis. The bad news is there will be a significant economic slowdown, and this is going to be a bad year for asset prices. Now, if I had to describe the global economy, the IMF calls it the new mediocre. I call it the new abnormal. Terms that did not even exist 10 years ago are now the norm. Who had heard 10 years ago the term ZIRP, zero interest rate policy, the term QE, quantitative easing, the term CE, credit easing, the term NDR, negative deposit rate, the term FG, forward guidance, or FX intervention? This is totally unconventional. The causality is not going from money increasing causing inflation, but the lack of inflation causing central banks to become increasingly unconventional. We live in a world in which there is a global savings glut, there is a global investment slump, where there is too much supply of goods, services, labor, and so on, and not enough demand for goods and services, in part because we have the mistaken policy mix. Too much reliance on monetary policy, too little reliance of fiscal policy, infrastructure spending, and things that boost aggregate demand. And that's the world we live in right now, of a conventional monetary policy. Think about this technological innovation that everybody here or in Silicon Valley is giddy about. Unfortunately, these technological innovations are becoming increasingly capital intensive, skill bias, and labor savings. So if you're an owner of financial and economic capital, you're going to do well. If you have skills like all of you here, you're going to do well. But if you're a low middle skill worker, blue collar by white collar, your jobs and income is going to be displaced by technology. Populist parties of the right and the left that are against free market, against technology, against trade, against globalization, against migration are becoming more popular in the core and periphery of Eurozone, in the US with the Tea Party, in the Middle East, even in Asia. And that's going to become socially and politically a problem. If inequality rises and we don't find a way to make sure that trade, globalization, and technology benefits all, eventually there will be a backlash against globalization. So I know that technology can be making us all better off, but some of the consequences of technology for jobs, for income, for inequality, for distribution of gains, for social and political instability are things that have to be discussed.